This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Sunday, July 26, 2026, and this is the After Hours session. Now, let's get into it. Fear at 14. That is not a typo. That is the fear and greed index hitting the absolute floor, signaling extreme capitulation. We are staring down the barrel of the FOMC meeting on Wednesday, July 29th, with the US dollar index at 120.53 and gold holding at $4,055. The market is screaming for safety, yet the smart money is quietly piling into risk assets. How do we reconcile this disconnect? Welcome to ShadowQuant's Week Ahead. I'm your host. The regime is extreme fear, but the positioning tells a story the headlines aren't quite capturing. Let's get into the data. We are opening the week with a market in a state of high contrast dissonance. On one hand, the fear and greed index is at 14/100, placing retail investors in a state of near total paralysis. On the other, the commitment of traders, COT data from July 21st, shows commercial hedgers at the 100th percentile for long positions across equities, gold, and major currencies. The VIX closed at 18.58 on Friday, sitting in a mild contango with the 3-month VIX at 20.51, suggesting that while near-term fear is high, the market isn't pricing in a systemic crash, just a volatile wait-and-see period. Liquidity is very loose, according to the NFCI, which is the only thing keeping the risk-on regime score at 47.5 alive. We have a massive catalyst cluster ahead. GDP now estimates the FOMC decision on Wednesday and BOJ decisions on Thursday. Let's break it down. I want to start with the macro reality, because the extreme fear label is masking a very specific structural shift in interest rates. The Fed funds rate is currently at 3.63%, with the 2-year Treasury at 4.37% and the 10-year at 4.71%. The 10-year 2-year spread is at plus 0.36 percentage points. For those watching the yield curve, this is a normal shape, but it is historically tight. We are seeing normalization, not inversion.
Let's look at the charts, because price action doesn't care about sentiment scores. Euro-dollar is currently at 1.13712. Looking at the 5-day history, the range has been 1.13638 to 1.14358. We are sitting right in the middle of that range, essentially flatlining after a small decline from the 1.14358 high on July 23rd.
I'm looking at the flows, specifically the CFTC commitments of traders' data from July 21st, and the divergence is staggering. Leveraged funds are strongly bullish on Euro, plus 1,209 net, plus 1,363 week-over-week change, and strongly bullish on Yen, plus 1,209 net, plus 97,394 week-over-week change. Wait, let me reread that Yen data. The Yen leveraged fund net position is plus 1,209, but the week-over-week change is plus 97,394. That is a massive, explosive shift in positioning. Leveraged traders are flooding into Yen longs.
I'm here to stress test the extreme fear narrative. Everyone is looking at the 14/100 fear and greed index and saying it has to bounce. I disagree. Extreme fear can persist for weeks. The risk here is not a bounce. The risk is a volatility trap.
Let's tie this together. Pulse gives us a macro of sticky inflation, slowing growth with the Fed on pause. Grid shows technical compression in euro-dollar and dollar-yen, waiting for a breakout. CIPHER sees massive institutional alignment on dollar strength and a huge influx of yen longs by leveraged funds. SPECTER warns that the extreme fear is a trap and that credit spreads are rising, suggesting hidden weakness in risk assets.
So we have a unified view. Macro is hawkish due to sticky inflation. Technically, we are compressed and waiting for breakout. Flows favor dollar and yen. Risk is a volatility trap. Let's hear the weekly calls.
My call: Euro-dollar bearish, target 1.135 by Friday. The catalyst is the FOMC on Wednesday, July 29th. With core PCE at 3.41%, The Fed will likely signal that cuts are not imminent. This keeps the 10-year yield at 4.71% bid. The macro data, GDP 2.9%, does not support a euro recovery. I expect the euro to drift lower toward the 1.135 support level, which is the 5-day low area.
My call, dollar-yen bullish, target 164.5 by Friday. The catalyst is the technical resistance at 163.988. We closed Friday at 163.847, just below the 5-day high. If we break and hold above 164 ahead of the FOMC, it confirms a continuation of the uptrend. The 10-year 2-year spread is normalizing, supporting dollar strength. I see a move to 164.5 if we clear that 163.988 resistance on Thursday.
My call, Aussie dollar bearish, target 0.692 by Friday. The catalyst is the COT data showing leveraged funds are strongly bullish on Aussie, plus 24,788 net, but the week-over-week change is negative 2,434. This suggests the bullishness is fading. More importantly, the Canadian dollar is being dumped heavily, 98,377 net. And Aussie often follows Canadian dollar in risk-off environments. With the fear and greed index at 14, risk currencies get sold first. I expect a drop to 0.692 as flows rotate out of Aussie.
My call, cable neutral, target 1.33 range bound by Friday. The catalyst is the COT divergence. Leveraged funds are neutral minus 154 net, but asset managers are net long plus 16,284. This creates a floor. However, the 5-day low is 1.32989. I do not expect a breakdown below 1.33 because the institutional long positions are too heavy. But I also don't see a breakout above 1.34. I expect cable to chop between 1.33 and 1.335, trapped between leveraged fund indecision and asset manager support. My call is a hold, no trade, or a tight range play.
My call, euro-dollar bearish, target 1.132 by Friday. The catalyst is the combination of FOMC hawkishness and COT asset manager dollar longs. The 1.136 support is weak, as seen in the 5-day low of 1.13638. If the FOMC on Wednesday, July 29th, maintains a higher for longer stance, the euro will break that support. I am targeting 1.132, which is below the current 5-day low, as a stress test of the euro's resilience against a strong dollar. This aligns with the risk-on regime being fragile, and the extreme fear being a signal to stay defensive in dollar/euro.
So the consensus is clear. Euro-dollar is under pressure. Dollar-yen is testing resistance. Aussie dollar is facing flow headwinds. Cable is stuck in neutral. And the big event is the FOMC on Wednesday, July 29th. If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Forex trading carries significant risk of loss. Always do your own research before making any trading decisions. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.